Ladies and gentlemen, we are back with yet another crypto live stream. And today, we are covering the United States FOMC meeting, or more colloquially known as the crazy event of the month, where obviously the new interest rates for the US get announced. Right now, the expectation is that, as you can see right here, we go from 5.5 to 5.5, not a change. If we do end up changing and deviating from this 5.5% number, that would be pretty crazy. And I do expect some crazy price movements to happen if that were to occur. But the probability, as of this point, I'd call it rather small. I'd call it rather nearly insignificant. So what's going to happen over the next couple of minutes? Well, in just a few, I'm just taking a little text message. In just a few minutes, we've got ourselves the interest rate decision in about 4 minutes or so. And then in another few minutes afterwards, let's say 30 minutes after, we get ourselves Jerome Powell's speech where he covers exactly what's about to happen next. And I reckon that this is actually one of the more important speeches he's given, as people are wondering whether or not these numbers are going to come back down. Right? Because right now the interest rate numbers are extremely high, and the question all around the world is, when exactly are we going to start dropping? Is it in May? Is it in March? When is it going to be? And obviously, whatever answer comes out of that is rather important. And now, there are a lot of talks going on. Gold prices firm as spotlight shifts to the US Fed policy meeting. And as you can see here, gold gained on Wednesday, but was on track to snap its 3-month winning streak, while markets were glued to the US Central Bank's policy rate outlook discussion later in the day. Spot gold was up 0.7%, and I'd say that Bitcoin was also doing pretty well from its dip. Right now, if you are wondering, Bitcoin is at $43.5 thousand, doing pretty amazing throughout the last couple of hours here. And I'd say it's also recovered pretty beautifully from its dip. By the way, if you're watching this right now, let me know in the chat box where you're watching from. I see a couple of you guys have already joined in. Many are probably not in the chat yet. But let me see how many of you guys are here. 3-digit coming in from the UK. We got global investments from Finland, Mend and Extend from Canada, Nanestad Boy from Norway, Mohammed from Australia, Scar from us says hi, Knuckles from Netherlands, hey, Tristan from Toronto, Lala from the UK, Michael from Florida, Tyler, he says he's here, Papendrecht. Alts are bleeding to Bitcoin, Dusty. Yeah, I mean, it's the season. It's not altcoin season yet, as we talked about before. We still have a little bit of ways to go. And if you're wondering about the ETA, estimated time of arrival, it's about 1.5 more minutes, I believe, until we get ourselves the interest rate numbers. And then about 25 minutes after that, we get ourselves the Jerome Powell speech. The Jerome Powell-led U.S. Federal Reserve, or the Open Market Committee, FOMC, is set to announce its monetary policy decision on benchmark interest rates today. The Fed policymakers have signaled that a reduction in key U.S. interest rates may not happen in their first meeting of the year, which is again today. Economists expect the FOMC will wait until June, which again is why this meeting afterwards, or the talk I should say, is so important, given ongoing strength in household spending and uncertainty over the economic outlook. The Fed has kept the benchmark overnight interest rate in the 5.25 range since last July. And the U.S. Commerce Department last week showed inflation increased 2.6% in December from a year earlier. And the underlying inflation on a 6-month and 3-month annualized basis is now running below the central bank's 2% goal, news agency Reuters reported. Following the release of the data, traders slightly favored the Fed's April 30th to May 1st policy meeting over the March meeting as the likely kickoff for a series of rate cuts this year. And here are the latest updates, yada, yada, yada. Well, we are waiting now for the result to come in. As you said before, the previous number was 5.5, expected number 5.5, and what is your expectation? Say more cuts or increase. But say more cuts. What do you guys think? Just say now. You have a couple more seconds to comment it. Ooh. Who's right and who's wrong? Okay. It's loading in. Why is it so slow? I have Twitter open on the side, but nobody's tweeting it out yet either. I think a lot of people just have it like set on their phone to just comment and say it's the same, even though they didn't officially get the notice yet. Because I have the instant source in front of me, but it didn't post. For some reason. Why not? It's going to be no change, though. 99.9% sure. No change! Sorry, guys. I'm sorry if you had headphones on. I'm so sorry, everybody. Hopefully you're all good. It's no change. Lucky us, huh? No, okay, so this was one of the easiest ones to expect or to predict, I'd say, because the probability of this changing was so ridiculously small. It would have been like 3 months before the it would have been too crazy. It would have been funny though. Let me just quickly tweet out as well. The Federal Reserve kept the fund rates unchanged at some crazy high levels. Look at that, huh? That is wild. So again, if you're wondering right now, we have to wait ever so slightly for the, yeah, sorry everybody for screaming in your ear. We have to wait ever so slightly for Fed Chair Jerome Powell's speech, because I think it's going to be interesting. At least I personally want to watch it. And you guys are going to watch with me, hopefully, because I want to see what exactly he is all about. I thought I copied that just now, but I didn't. You guys didn't see it. I also, by accident, bought the most clickiest of keyboards. Now that I thought about it, for streaming, I'll direct the microphone to it for a second so you guys can enjoy it. Listen to this. Listen to this amazing sound. That's awful, right? It's like a little keyboard. Yeah, that was not a smart decision. Side note, now that we're waiting for the news anyway, did you know that SSDs became so ridiculously small? Multiple terabytes in such a small... Great things come in small packages. I'm not sure if you've ever heard that before. I've never. But maybe you have. This is proof, you know? Great things come in small packages. Breaking. Just quickly typing out. There we go. We good? We good? Test. Okay. I'll say my joke again. It's not as funny the second time, but I'll still do it anyway. All right? Did you know how small, because we're waiting for the FOMC meeting to roll around where Jerome Powell's going to give his thoughts. We have to wait about 20 minutes. So I'm just giving you one little joke. Did you know that these SSDs, so terabytes, multiple terabytes worth of data, now come in such crazy mini packages? And I mean, they often, at least somebody told me, maybe you know, but I didn't, that great things come in small packages. Never heard that before, but I saw the saying somewhere. And this proves it, right? This is crazy to me. I thought it was because I have these old ones that they're big, but this is crazy small, no? It's like just you can just put it in your little pocket. It's mini. It's crazy to me. Anyway, call me a geek for that one. I think that's funny, though. I think that's funny as crap. That it's that small. Damn. Okay, so expectation. I personally think even this talk here is not going to be too groundbreaking, too crazy. Because obviously it is just Jerome Powell giving his opinion and his expectation coming into the next couple of months. But we already know it. The only question is, do we get more of an indication as to when rate cuts are going to happen? Is it going to be June? Is it going to be May? Is it going to be slightly earlier? That's where a lot of the ruckus, the discussion was about earlier. When I just read this for you guys from CNBC, It's actually from Reuters. They just, or Reuters. I don't know how you pronounce that still. Echo? Are we still not good with the mic, guys? Let me hear it. Let me hear it. No, we're good. Nanas says he's going to have the speech wearing an XRP for life shirt. How many of you guys hold XRP in the chat? Baran says Saudi for the 𝗕𝗓. At the end of the day, you never know, right? You never know. It could be that I'm just recording the whole time and the mic has not even worked for a second. So I'd rather just ask you guys sometimes. That would be funny. Can you imagine me sitting here for an hour not looking at chat and I've not had a single second of sound? You don't even want to know how many videos I've recorded without sound in my time here. It's a lot. It's a lot. It's a lot of content that I made for nobody because the mic was not picking it up. Let's see here. Fed meeting today. FOMC keeps rates steady. What's Jerome Powell's speech next? Follow live coverage. The Federal Reserve kicks off their yearly first meeting in neutral, opting to keep interest rates unchanged at a meeting of its policy setting committee today. The call, which is widely expected, again, is to make it stay the same, which it is. Attention now turns on the FOMC's policy statement, again in 20 minutes, and commentary from Fed Chair Powell. At 2:30 p.m., he will take the stage at the post-meeting press conference. And that is ultimately the only thing I care about when it comes to these meetings. But most of the time, he doesn't say anything too crazy. It's just sometimes a crazy bit comes up and you see prices move so much because of the one thing which he said. And that's usually, this is the XRP price, by the way. We're still not in the craziest of spots, not in the most beautiful of spots, but hey, it ain't too bad. It ain't too bad. Here we go. Did you guys also see my previous video talking about how Chris Larson, or live stream, that Chris Larson got hacked? Did you know it just got community, how do you say, community striked or community? It's not been popped up yet, but it's kind of funny how Twitter is becoming pretty good with these community notes. As said, it's not fully, we have to still rate it, but the fact that this is coming up is nice. He also said this is an isolated incident and Ripple wallets are secure / were never compromised. We've confirmed nearly all of the affected funds were converted out of XRP. We're working with law enforcement and have been advised that a significant portion of the funds have been frozen and are pursuing the remainder aggressively. Many thanks to the 𝗕𝗓𝗄𝗓 Foundation, 𝗕𝗓𝗪, for the help. Interesting. So this person already sold probably $100 million or something like that worth of XRP here. Interesting. Pronounced very good, Saudi for 𝗕𝗓𝗪𝗧. Sounds like a Dutch man. All right, interesting, interesting. I hold a lot of XRP. My back is 100%. Okay, let's see here for fun. How many of you guys only hold one coin? Wait, what? Ryan says, no one needs to know how much you hold. Definitely not too smart. But also, in my opinion, right? Honest truth opinion, I don't think it's too wise to only have one crypto. Honest truth for you. Honest truth. It's not that wise to have only one crypto, in my opinion. Jason says you have to at least have 10 now to open a wallet. If you're talking about XRP, yeah, it was 20 before. I think it's 10 now. It's like the reserve to prevent spam, which can get lowered eventually as well. It's not that relevant though, but yeah, you need to have a couple of coins, like $5 worth to open an account. But I think as time progresses, that number will lower, most likely. But it's mostly, as they said, just to prevent spam. It's not necessary, but it can help keep the pressure down. That is for XRP only, by the way. For most of the cryptos, there's no minimum. On the opposite side, what is a wallet if there's only $1 in it, right? Doesn't mean that much. Most wallets will have a couple dollars or nothing in it. Mine, almost all of them that I have like nothing in have like 30 cents, etc. And I think it's actually more of a nuisance. Because at 30 cents, you can really not do anything. One second, I'm just texting somebody back. We're still waiting for this anyway. We are still waiting for the stream to come on. I'll just quickly pop open the stream at least so we can share Powell speech. So we can hopefully tune in pretty quickly the moment that it does start. Yeah, about 15 minutes left or so. They already play an advertisement. That's one of the funny things as well. You know, my video once got taken down because we played a video here and they had an advertisement which had a copyrighted song. If you guys have been here for a while, you might know. Actually, our channel got taken down multiple times, but that was not the channel getting taken down, just the video. MJ says, get a ledger, problem solved, which is why I worry so much about how Chris Larsen lost his funds and exactly how that happened. Because you would expect him, being such a smart businessman, to not have been too foolish with his money, especially if we're talking $100 million. So I sometimes do wonder exactly where it went wrong and how he did lose it. And Maniac says, have you people heard of diversification, just basic investing? Yeah, I mean, to some extent, I often think, you know, with this crypto stuff, I don't really think, for some people, right, it's bad to have only one thing. Because you can see it as a matter of either I have something or I don't. It's like roulette. Because you can kind of say like, oh, with the roulette wheel, you have to put on multiple numbers. You got to diversify. Yeah, but in theory, right, your diversification could be one crypto, but just crypto as an asset class. But then it's specifically just one. You got some stocks, for example. You got a house. You got something else you're investing into. But just one type of crypto. It could be seen as a piece of diversification from your main portfolio, which has different things. Could be. Then again, not my personal recommendation. Still, I personally think it's wiser to have multiple, but I'm just saying I could understand the philosophy, and I can also understand it from the philosophy of go big or go home. Then again, my personal thoughts is that it's not so wise. Gento says, when FOMC, what more minute? 14 minutes for the speech from Jerome Powell. And it usually, you've had 3 ads pop up. Ads are off. So I'm not so sure if that's only on your end. You only have 1 ad when you come into the stream. What's a good number for diversification? When does one become too diversified? My personal thoughts are that you guys have had 3. Let me check. Okay, I messed up a little bit. It's on every 6 minutes. My bad. You guys are right. Never mind. Normally it gives me a little button at the top, bottom left that says there's an ad gonna play and I can press skip. But my bad. All right, I accidentally, I might have made $1 off you guys. My bad. That is my mistake. Honest mistake, but it's fixed. Should have no more ads. Cashing in. You caught me. You caught me. You caught me. Damn. So, I like that. Somebody asked, what is too much diversification? I personally think there's not such a thing as too much. However, in my own personal investment life, I'd say the moment you get too diversified, the moment it gets annoying, I'd say, is when you have very little amounts in every one of them, and the change doesn't mean too much to you. For example, if you invest $1,000 into every single crypto, and you have a fair distribution in the sense that you have an equal 1,000 everyone, I'd say it's pretty easy to spot whenever one pumps. So it's fairly simple to keep up with it and to see the gain, see the benefit. If you have, for example, $10,000 in Ethereum, $5,000 in XRP, $1,000 in another coin, $500 and $300 and $100 and then $200 here, $200 there, $200, $300 there. The reason I say I'm not a big fan is because even though I sometimes get lucky with coins I have $1,000 in, and you guys saw Nosana, for example, I invested in 2021. In the end of 2023, October 2023, it was worth 1 cent, the crypto. So my money went divided by 10. And now it's worth what? $1.70. So basically, if you invested $1,000 3-4 months ago, right now it'd be worth $170,000. And I personally held that crypto all the way to the bottom and right now to the top. I sold some at 50 cents, but the point's still clear. A little bit of coconut water, guys. I love this coconut water. I don't even know what it's called. Rubicon. It's good. But so if that's the way you're doing it, where it's just smaller and smaller and smaller, then sometimes it can get rather annoying. Personal thoughts. But if you're doing it on a fair basis, so 1,000 in every single one of them, I personally don't think it's too stupid. But it just depends as well. How many cryptos are you really bullish on, huh? And why I give you the $100 example is because some people think, oh, $100 in a crypto or $1, for example, is not going to make a difference. But it really could go times a couple hundred if you're lucky. It can actually happen. And I think a lot of people have not witnessed that or forget, or they focus on some big gains or whatnot. But it can definitely happen, and it does happen every now and then. A lot of the coins I talk about on this channel, for example, those usually go hard on launch, right? But sometimes, just sometimes, I take time as well to just look for coins that are down a lot, that have got something good going for them. With Nosana, I'm going to be honest with you, I kind of thought of selling it at the bottom, but I think I forgot, or I just thought it's not worth it anymore. Because to me, if you only have $1,000 left, for example, it's like, well, at that point, why sell it even, right? It's just too little. But then you now see how crazy things can go. Port says, are you aware of the rising wedge on the 4 hour? For which coin? For Bitcoin or for XRP? Nana says, some go hard on these ISO coins. And again, another thing you can ask yourself is, if you want to diversify, do you want to diversify into different sectors or into different cryptos, period? So as an example, you could have only ISO, only payment type of coins. You can have only gaming coins. You can have only AI coins. And there's a philosophy that says if you focus on one area, you'll be the master and you'll be good. But there's the opposite side, which is you don't know which sector is going to pop off. So you'd rather go little bits into every single one of them to make sure that you reap the benefits of the craziness while not being certain of which one's going to pop off. Then again, I'm not sure what the saying is in English, but they say like a master of many traits is a master. No, a person of many traits is a master of none, something like that. One of you guys must know the saying, exactly what it is and how you say that. A jack of all trades. There we go. A jack of all trades is a master of none, of none. And I do kind of sometimes think of that too. Whereas I, for example, have given you guys many different sorts of ways to make crazy amounts of money in crypto. Every single one of them works. I can tell you right now, there's a kid on Twitter, not sure if it's real, but he says he farmed $1 million worth of the Jupiter airdrop. It's not that crazy to do. It's pretty unique because people don't want to take the time to really, really master it. But in the weekend, I'm her master. But it's actually doable to farm, if you have, for example, $1,000, to farm $20,000, $40,000 worth of an airdrop. If you really go for it and you master it, you find out everything about it and you focus on it. The only problem is the coin might never get an airdrop going. There might be so many people doing it that you still have not got much, or you were just not dedicated enough. I mean, there's many different things that can happen there. But the point there being, again, if you are not focused on just one area, there's so much that is going to be hard to really excel in a certain point. So from that perspective, diversification is kind of stupid. So it just depends on your perspective, I'd say. Anyway, we still have got about 9 more minutes to go or so. This is always a little awkward middle period where you're just waiting for the FOMC to come around. And what's funny is when you're really, really waiting like this, it takes such a long time. Let's see what Port says. Port says Bitcoin. Let's open up a couple Bitcoin charts on the side. I think I have some open still, actually. Oh, this is our... Oh, you guys can't see. This is our little, what we said before, our buy the rumors, sell the news. And this is really funny to me, the fact that we talked so much about... it's actually funny that this is acting as a support, even though it was a joke. This line has no resemblance in the real world, but I guess my lines are just so accurate that it just gets picked up regardless. I think that's kind of funny. But this line was just to show the buy the rumor, sell the news idea that we had. And it did play out pretty nicely. Again, our main buying zone was about $39,000. And I think that was one of the best areas to buy at. I think I've lost a couple of my charts here. For some reason, I don't have them open anymore. We'll have to check it out a little bit later. Let's see here if I can find some of these charts. The main one I'm looking for is the one where we talk about buying. Let's see, give it a little second. Might be CME. No, okay, might be. I'm just trying to find a very specific chart, but it could be so many different ones. And again, we still have a couple more minutes to go, right? We still have to wait a little bit. And so I'm just quickly scrolling through. I think it might be this one. No, it is not. Okay. Last little line of defense. No. Here we go. Perfect. So we've been talking for a good while. This is all on Dusty Trades if you want to see more about it. Where exactly we're buying, where exactly we're selling, what our ideal price range would be. And one of the funniest parts is just how profitable Bitcoin can be if you are just consistently buying your way down lower. Which is why I showed you guys what the bots do, right? Those bots that I've got set up, all they do is automate that stuff for you. So it just makes sure that you can buy your way down lower without having to click every single... Encoding overloaded. Turn down video settings. I was just trying to turn off some stuff. We good now? I think so. So, can I grab the bot? Yeah, so here's, for example, one of the Bybit things we had running. And I definitely do not want you guys to copy these because these are just for fun. But as you can see, the idea here was just put $100 in and let it just martingale, just buy its way down. And very often in the bull market, it doesn't end up breaking you or liquidating you, more importantly, because it never goes down that much. And if it goes down 35% or so, it's not that big a deal. The only issue comes when it goes down like 85%, but that's where you have to add more margin and be able to stick around for a little bit. And why you only do this when the narrative is extremely bullish. And the same thing applies to the OKX part. For example, if you take a look here, the bot right now, I think we put $2,000 in or so, but it trades with not that much money, especially when the market just keeps moving up and up and up. And over the last couple days, it's up $70 or so for me not doing anything, which is 3.5%. You might consider that to be really, really bad. I don't really care what you think in that regard. It's just so extremely, extremely simple. And we have many of these running on BitGet as well. It's done 13 cycles here in this case. And you can see it's down a little bit right now. Some people can't handle that, but that's because there's a dip going on. But yeah, people could just copy this bot literally. You didn't have to do anything. Even from the start, the moment I opened it, I put it up on my channel so you guys can just copy the bot. It's very simple to do. There's not really much involved that you needed to do except for press copy. But yeah, let me just quickly read what you guys are saying, because we are about 3 minutes more to wait till the meeting comes in. Hey, what's the worst coin you've ever bought? And Nana says, it's those flash crashes that's dangerous. Yeah, but that's why you got to be alert and add more margin. Theoretically speaking, you could actually have orders as well that have a limit very, very low. So you could add an additional limit order, for example, at what? 31,000, for example, in case things do really, really get bad. But most of the time that it's like, that's the really, really unoccasional times where somebody liquidates so much money that the price crashes by like 25% in a row. Because if it's your first or second order, your liquidation price is so low that it doesn't really matter. It's only when it gets to buy lower and then there's a crazy dip. Okay, so some of the worst coins are Jasmy, Alien Base, ARRR, 𝗕𝗘𝗪𝗔𝗥𝗘 coin. What happens in 3 minutes? Then we've got ourselves the Fed Chair Jerome Powell speech. What you basically came here for, I hope. That's the most important part here. And I might end the stream straight off afterwards. I'm not so sure if I'll still be here. Sometimes I just end the stream the moment it's over. Sometimes we go back to reflect on it. It depends on how busy it gets. And we might I might go ahead and do that real quick. On the side here, I'm right now making sure you guys have a little chart on the side to keep watching the Bitcoin price as things progress. So I'm just quickly setting that up now. No 24-hour stream. 20. What do I look like a robot to you, my friend? What do you mean a 24-hour stream? If you want, you can come here and definitely do it for 24 hours. I mean, if you really want to, maybe we could set that up. You're just here screaming at the screen for 24 hours. Could be kind of funny. $24 my friend. Damn. All right. And now I should add. All right. It becomes an interesting matter now of puzzle. My friends, it's time to go puzzle. So we've got ourselves the FOMC meeting here. We're going to full screen that. And then we've got to insert a chart for Bitcoin somewhere. To the right? Is that where we want to have it? Like this? Maybe. And I'll just put a little text over it as well. It says, there we go. Okay, I might not want to. There we go. Also, don't get scared when the thing just starts blazing. Because at some point it's going to start in about a minute or so. I think it should be good. I'm not sure where exactly in the screen he is. Maybe he's like middle. Then we might have to change it up a bit, but let's see. We shall see, my friends. We shall see. 24-hour stream, that's a Twitch thing. Imagine sitting there in a pool in the living room talking about crypto. Nah, forget that. Get rid of the chat. There's no chat in the screen, right? It's gonna be quite difficult, I think, to do 24 hours crypto, because what are you gonna talk? I guess whenever new news comes out, you can keep bringing it up, but is it that often? I guess so, right? I mean, there's probably ways to do it, but you need a lot of people to talk with. If you do it alone, it's gonna get very boring very quickly. If you got a whole army, you can probably get something pretty cool going. It is officially time, by the way. Bitcoin's price is not doing so well as of this moment. And I'll put a baseline as to where we started. The moment we do start.
We've been seeing the has eased and progress on inflation has continued. The risks to achieving our employment and inflation goals are moving into better balance. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. GDP growth in the fourth quarter of last year came in at 3.3%. For 2023 as a whole, GDP expanded at 3.1%, bolstered by strong consumer demand as well as improving supply conditions. Activity in the housing sector was subdued over the past year, largely reflecting high mortgage rates. High interest rates also appear to have been weighing on business fixed investment. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 165,000 jobs per month, a pace that is well below that seen a year ago, but still strong. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up on balance over the past year, particularly for individuals aged 25 to 54 years. And immigration has returned to pre-pandemic levels. Nominal wage growth has been easing and job vacancies have declined. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. Inflation has eased notably over the past year, but remains above our longer run goal of 2%. Total PCE prices rose 2.6% over the 12 months ending in December. Excluding the volatile food and energy categories, core PCE prices rose 2.9%. The lower inflation readings over the second half of last year are welcome, but we will need to see continuing evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective. Over the past 2 years, we have raised our policy rate by 5.25 percentage points and we've decreased our securities holdings by more than $1.3 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We believe that our policy rate is likely at its peak for this tightening cycle, and that, if the economy evolves broadly as expected, it will likely be appropriate to begin dialing back policy restraint at some point this year. But the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. The economic outlook is uncertain, and we remain highly attentive to inflation risks. We are prepared to maintain the current target range for the federal funds rate for longer, if appropriate. As labor market tightness has eased and progress on inflation has continued, the risks to achieving our employment and inflation goals are moving into better balance. We know that reducing policy restraint too soon or too much could result in a reversal of the progress we've seen on inflation and ultimately require even tighter policy to get inflation back to 2%. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess the incoming data, the evolving outlook, and the balance of risks. The committee does not expect that it will be appropriate to reduce the target range until it has gained greater confidence that inflation is moving sustainably toward 2%. We will continue to make our decisions meeting by meeting. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our questions.
Now the craziness starts, guys.
Taking our questions. Obviously, in the statement and just in your remarks there, you note that you don't want to cut interest rates without greater confidence that inflation is coming down fully. I wonder, what do you need to see at this point to gain that confidence? And as you make those decisions, how are you weighing recent strong growth in consumer spending data against the sort of solid inflation progress you've been seeing?
Sorry, say that last part again.
How are you weighing the growth data and consumption data, which have been surprisingly strong, against inflation data?
Okay. So what are we looking for to get greater confidence? Let me say that we have confidence. We're looking for greater confidence that inflation is moving sustainably down to 2%. Implicitly, we do have confidence and has been increasing, but we want to get greater confidence. What do we want to see? We want to see more good data. It's not that we're looking for better data. We're looking at continuation of the good data that we've been seeing. And a good example is inflation. So we have 6 months of good inflation data. The question really is, that 6 months of good inflation data, is it sending us a true signal that we are in fact on a path, sustainable path down to 2% inflation? That's the question. And the answer will come from some more data that's also good data. It's not that the 6-month data isn't low enough. It is. It's just a question of, can we take that with confidence that we're moving sustainably down to 2%? That's really what we're thinking about. In terms of growth, we've had strong growth. I mean, if you take a step back, we've had strong growth, very strong growth last year, going right into the fourth quarter. And yet we've had a very strong labor market, and we've had inflation coming down. So I think, whereas a year ago we were thinking that we needed to see some softening in economic activity, that hasn't been the case. So I think we look at stronger growth. We don't look at it as a problem. I think at this point we want to see strong growth. We want to see a strong labor market. We're not looking for a weaker labor market. We're looking for inflation to continue to come down as it has been coming down for the last 6 months.
And I'm sorry, if I could just follow up very quickly. When you say that you want to make sure that it's a true signal, is there anything that you're seeing in the data that makes you doubt that it's a true signal at this stage?
No, I think I would say it seems to be the likely case that we will achieve that confidence, but we have to achieve it, and we haven't yet. And so, I mean, it's a good story. We have 6 months of good inflation, but you can, and you know this, you can look behind those numbers and you can see that a lot of it's been coming from goods inflation, for example, and goods inflation running significantly negative. It's a reasonable assumption that over time, goods inflation will flatten out, probably approximate zero. That would mean the services sectors would have to contribute more. So, in other words, what we care about is the aggregate number, not so much the composition, but we just need to see more. That's where we are as a committee. We need to see more evidence that sort of confirms what we think we're seeing and that tells us that we are on, gives us confidence that we're on a path to, a sustainable path down to 2% inflation.
Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, it seems to me you raised rates rapidly over the last 2 years for two reasons. One was the risk of a wage price spiral. Two, there were risks of inflation expectations becoming unanchored. This morning's ECI report for the fourth quarter shows private sector payroll growth running at a sub 4% pace. Inflation expectations are very close to where they were before the inflation emergency of the last 3 years. And given that you appear to have substantially cut off these two tail risks, and that you've judged here today current policy is well into restrictive territory, what good reason is there to keep policy rates above 5%? Are you really going to learn more waiting 6 weeks versus 3 months from now that you have avoided those two risks?
So, as you know, almost every participant on the committee does believe that it will be appropriate to reduce rates. And for partly for the reasons that you say, you know, we feel like inflation is coming down, growth has been strong, the labor market is strong. What we're trying to do is identify a place where we're really confident about inflation getting back down to 2% so that we can then begin the process of dialing back the restrictive level. So overall, I think people do believe, and as you know, the median participant wrote down 3 rate cuts this year. But I think to get to that place where we feel comfortable starting the process, we need some confirmation that inflation is in fact coming down sustainably to 2%.
If I could ask differently, if you hold rates high as inflation moderates, as it has been, target rates will exceed the prescriptions of the Taylor rule or its variants. What would be the reasoning for holding rates higher than the levels recommended by those rules in the current instance?
Well, look, I think, as you know, we consult a range of Taylor rules and non-Taylor kind of rules. We consult them regularly. They're in our Teal book, and they're in all the materials that we look at. But, you know, I don't think we've ever been at a place where we were setting policy by them. And they're, depending on the rule, it will tell you different things. There are many different formulations. Another way to think about it is, implicitly, is so. In theory, of course, real rates go up if holding all else equal as inflation comes down. But that doesn't mean we can mechanically adjust policy as real rates, as inflation comes down. It doesn't mean that at all, because for one thing, we don't know. We look at more than just the Fed funds rate. We look at broadly financial conditions. But in addition, we don't know with great confidence where the neutral rate of interest is at any given time. But that also doesn't mean that we wait around for to see, you know, the economy turn down, because that would be too late. So we're really in a risk management mode of managing the risk, as I mentioned in my opening remarks, managing the risk that we move too soon and move too late. And I think to move, which is where almost everyone on the committee is in favor of moving rates down this year. But the timing of that is going to be linked to our gaining confidence that inflation is on a sustainable path down to 2%.
Howard.
Hi, thanks, Chair Powell. I'd like you to key in on the use of the word in the statement that inflation still remains elevated. You've pledged to cut rates before inflation reached 2%. So that implies that there's some sort of intermediate step here on inflation, and that a cut would be consequent with a change in the statement language that inflation remains elevated. What's the step down from there?
Yeah, I don't know that we've worked out the particular statement language and that kind of thing. I would just say, if you look at where 12-month inflation is, And it's, you know, it's still well above, core is 2.9%, for example, 12 months, which is way down from where it was. Very, very positive development, very fast decline. And you know, the case is likely that it will continue to come down. So that's where it is. But we're wanting to see, you know, more data.
So if I could follow up on that, the statement allows that you want greater confidence on inflation falling before you cut, but it doesn't mention the other side of the mandate, a slide in employment. Would a slide in employment also bring you to the point of cutting rates? Yes.
So let me say that we're not looking for that. It's not something we're looking for. But yes, if you think about, you know, in the base case, the economy is performing well, the labor market remains strong. If we saw an unexpected weakening certainly in the labor market, that would certainly weigh on cutting sooner. Absolutely. And if we saw inflation being stickier or higher or those sorts of things would argue for moving later. In the base case, though, where the economy is healthy and we have, you know, we have ongoing growth, solid growth, we have a strong labor market, we have inflation coming down, that's what people are writing their SEP around. And in that case, what we're saying is, based on that, we think we can and should take advantage of that and be careful as we approach that question of when to begin to dial back restriction.
Claire Jones, Financial Times. Just to circle back to the greater confidence aspect of the statement, there's been a lot of unanimity in recent meetings. I'm just wondering, going forward, when it comes to all needing greater confidence, is the unanimity, or at least consensus among FOMC members, about what the threshold for that greater confidence is? And if not, could you maybe tell us a little bit about the discussion today on, you know, what the variations between FOMC members was on what constitutes enough confidence to cut rates, and also if there was any variation on how quickly that greater confidence threshold could be reached. Thank you.
We're not really at that stage. You know, there was no proposal to cut rates. Some people did, you know, talk about their view of the rate path. I would point you to the SEP as you know, as good evidence of where people are, although it is one cycle later. So, you know, we're not at a place of really working out those kinds of details because we weren't actively considering, you know, moving the federal funds rate down. I will say there is a wide disparity, a healthy disparity of views, and you see that in public statements, in the minutes and the transcripts when they're released every 5 years. So we do have a healthy set of differences, and I think that's actually essential for making good policy. We're also able to reach agreement generally because we listen to each other, we compromise, and even though not everybody loves what we do, they're able to, for the most part, able to join in. To me, that's a well-functioning public institution.
Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. So over the past few years, there have been all these real-time indicators that helped us gain a sharper understanding of where the economy was, like open table data or office attendance. You've talked about vacancies in the past. And I'm wondering at the start of this year, what might be on that dashboard for you that's giving you the clearest picture of the economy, including on rents, if you could touch on that.
Including?
Rent costs.
Yeah.
Yeah.
Well, so we're not, you know, it's not the pandemic, so we can actually rely on more traditional forms. People are working, they're getting wages, and the economy is largely reopened and is broadly normalizing, as you see. So I wouldn't say we're looking at that sort of more innovative data as much. You know, you point to rents, so of course we follow the components of inflation very carefully, which would be goods inflation. I talked about that a little bit. You mentioned housing inflation, so the question is, when will these lower market rents find their way into measured rents as measured in PCE inflation? And we think that's coming, and we know it's coming. It's just a question of when and how big it'll be. So, but that's in everyone's forecast, I would say. So that will help. But at the same time, we think goods inflation will probably, it's been giving a lot of disinflation to the effort, and probably that declines over time. But it may well have some more time to run. You know, the supply chains are not perfectly back to where they were. In addition, it takes time for the healing process to get into prices. So there may be still a tailwind. We'll find out with that. So we look at the things that relate to our mandate very carefully, and as you would imagine.
I guess just as a quick follow-up, do you feel comfortable at this point saying the economy has reached a soft landing, or is that part of looking for more confidence?
No, I wouldn't say we've achieved that, and I think we have a ways to go. Inflation is still, core inflation is still well above target on a 12-month basis. 12 months is our target. Certainly, I'm encouraged, and we're encouraged by the progress, but we're not declaring victory at all at this point. We think we have a ways to go.
Steve.
Thank you, Mr. Chairman. You've said that you would know the neutral rate by its works. So I'm wondering what you could tell me. How do you believe the neutral rate is working? We're telling you right now that growth is stronger. In other words, how much is the economy really being restrained right now by the current funds rate? And how much restraint does it really need additionally if inflation is still coming down?
So I think you do see in the interest-sensitive parts of the economy, you do see, for example, housing, you see the effects, you do. Your second question, though, really, I think is important, and that is a lot of this has come through, a lot of the disinflationary process has come through the healing of supply chains and also of the labor market. So you've seen that, that other set of factors is really different from other cycles and has brought that working with tighter policy, which has enabled the supply side to recover, I think is that mixture has been behind what has enabled this. So no, we really do think that we're having an effect broadly across the economy. I would point to the interest-sensitive parts of the economy as well as spending generally. But it's a joint story. It's a complicated story.
But how much restraint are you actually imparting to the economy, would you say, relative to the neutral rate?
So I think it's of course, you know that it's not something you can identify with any precision. But a standard approach would be to take the nominal rate, 5.3%, let's say, and subtract sort of a forward measure of inflation. If you do that, and there are many, many ways to calculate the neutral rate, but that's one I like to do. And you're going to get to something that is materially above mainstream estimates of neutrality, of the neutral rate. You will. But at the same time, you look at the economy and you say, this is an economy that grew 3.1% last year. And you say, what does that tell you about the neutral rate? What's happening, though, is the supply side has been recovering in the middle of this. So that won't go on forever. So a lot of the growth we're seeing it isn't just a tug of war between interest rates and demand. You're getting, more activity because of labor market healing and supply chains healing. So I think the question is, when that peters out, I think the restriction will show up probably more sharply.
Rich.
Thank you, sorry. Thanks for taking the questions, Mr. Chairman. You mentioned earlier we're not seeking a weaker labor market, I think that you said. Can you talk a little bit more about that? Do you think the labor market now is back to quote-unquote normal, and that we can achieve the inflation target without wage gains coming back down to what they were pre-pandemic? Even with today's ECI levels, they were still above those pre-pandemic levels.
I think the labor market, by many measures, is at or nearing normal, but not totally back to normal. And you pointed to one or more of them. So I think job openings are not quite back to where they were. Wage increases rather are not quite back to where they would need to be in the longer run. I would look at it this way, though. The economy is broadly normalizing, and so is the labor market. And that process will probably take some time. So wage setting is something that happens, it's probably will take a couple of years to get all the way back. And that's okay. That's okay. But we do see, you saw today's ECI reading, the evidence is that that wage increases are still at a healthy level, very healthy level, but they're gradually moving back to levels that would be more associated, given assumptions about productivity, are more typically associated with 2% inflation. It's an ongoing process, a healthy one, and I think we're moving in the right direction.
So that process can continue without a weakening of the labor market, basically, you're saying?
Well, I think the labor market is, I don't know if it's rebalancing. Clearly, there was a fairly severe imbalance between demand for workers and supply at the beginning of the pandemic. So we lost several million workers at the beginning of the pandemic from people dropping out of the labor force. And then when the economy reopened, you remember 2021, you had a severe labor shortage, and it was everywhere. Panic on the part of businesses, couldn't find people. So what's happened is we expected the labor market to come back quickly, and it didn't. And 2022 was a disappointing year. And, we were kind of thinking, well, maybe we won't get it back. And then 2023, we did, as you know. So labor force participation came back strongly in 23, and so did immigration. Immigration came to a halt during the pandemic. So those two forces have significantly lowered the temperature in the labor market to where it's still a very strong labor market. It's still a good labor market for wages and for finding a job, but it's getting back into balance. And that's what we want to see. And one great way to look at that is what's happening with wage increases. And you see it now across the major things that we track. It isn't every quarter, but overall, there's a clear trend, still at high levels, but back down to what would be consistent with where we were before the pandemic and with 2% inflation.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you. I wanted to follow up on Rich's question. It sounded like you suggested that you're not worried about faster growth so much. So wanted to see if you're seeing anything that suggests that inflation could reaccelerate from here. And it sounds like you're saying you're not worried that solid growth from here on out poses any risk to inflation. Thank you.
No, I think that is a risk, the risk that inflation would reaccelerate. I think the greater risk is that it would stabilize at a level meaningfully above 2%. That's to me more likely. Of course, if inflation were to surprise by moving back up, we would have to respond to that, and that would be a surprise at this point. But I have to tell you, that's why we keep our options open here, and why we're not rushing. So I think both of those are risks, but I think the more likely risk is the one that I mentioned, which is you've had 6 good months, very good months, but what's really going to shake out here? When we look back, what will we see? Will inflation have dipped and then come back up? Are the last 6 months flattered by factors that are one-off factors that won't repeat themselves? We don't think so. We don't. That's not what we think. But that's the question we are asking. We have to ask, and we want to get comfort on that.
And just one quick follow-up. Governor Waller had mentioned the revisions that are coming on February 9th for the CPI data. Is that something you're watching as well? And if we see those revisions fairly minor, is that going to give you more confidence where things are going?
We'll just have to see. Yeah, we'll look at those. Last year was a surprise.
Michael McKee, Bloomberg Radio and Television. If you don't want to use the term soft landing, would you say at least that from your point of view now, the other scenario of a hard landing caused by the Fed is off the table, or the risks have diminished very much? And you mentioned below 2% inflation on a 3-month basis. Core PCE has been running at 1.5%, and there are those on Wall Street who think that if you maintain the level of restriction you have right now, you could end up with inflation running below your target. How do you see that?
So your first question, how to describe where we are. So I guess I would just say this. Executive summary would be that growth is solid to strong over the course of last year. The labor market, 3.7% unemployment, indicates that the labor market is strong. We've had just about 2 years now of unemployment under 4%. That hasn't happened in 50 years, so it's a good labor market. And we've seen inflation come down. We've talked about that. So we've got 6 months of good inflation data and an expectation that there's more to come. So this is a good situation. Let's be honest. This is a good economy. But what's the outlook? That's looking in the review. The outlook, we do expect growth to moderate. Of course, we have expected it for some time, and it hasn't happened. But we do expect that it will moderate as supply chain and labor market normalization runs its course. The labor market is rebalancing, as I mentioned. Job creation has slowed. The base of job growth has narrowed. And of course, 12-month inflation is above target and getting down closer to target. It's not guaranteed, but we do seem to be getting on track for that. So those are the risks and questions we have to answer. But overall, this is a pretty good picture. It is a good picture. Your second question was, sorry.
Could you get inflation that is below target, end up with inflation below target, and you have to do something about that?
So the thing is, we're not looking for inflation to tap the 2% base once. We're looking for it to settle out over time at 2%. And the same thing is true. If we have a month or two of lower, and we have that now, of inflation that's annualized at a lower level, that wouldn't be good. We're not looking to have inflation anchor below 2%. We're looking to have it anchor at 2%. So if we do face those circumstances, then we'll have to deal with that. I think as of now, the question, we want to take advantage of this situation and finish the job on inflation while keeping the labor market strong.
Edward.
Edward Lawrence from Fox Business. Thank you, Mr. Chairman, for taking this. So as I've heard from some district Fed presidents, is it, in your view, a little premature to think that rate cuts are right around the corner? And then when we do see that first rate cut, should we interpret that as the beginning of a rate cut cycle, or is it a one-off?
So I'll point you to that language on your first question. We included that language in the statement to signal clearly that with strong growth, strong labor market, inflation coming down, the committee intends to move carefully as we consider when to begin to dial back the restrictive stance that we have in place. So if you take that to the current context, we're going to be data dependent. We're going to be looking at this meeting by meeting. Based on the meeting today, I would tell you that I don't think it's likely that the committee will reach a level of confidence by the time of the March meeting to identify March as the time to do that, but that's to be seen. So I wouldn't call, when you ask me about in the near term, right, I'm hearing that as March. I would say I don't think it's probably not the most likely case or what we would call the base case. Then your second question is?
Is this the start of when we see a cut, is it the start of a cutting cycle, or could it just be a one-off?
That's going to depend on the data. The whole thing is, this is going to depend on the data. We're going to be looking at the economic data as it affects the outlook and the balance of risks, and we're going to make our decisions based on that. And it could wind up, we'll have another SEP at the March meeting, and people will write down what they think. But in the end, it's really going to depend on how the economy evolves. We talked about there are risks that would cause us to go slower. For example, stronger inflation, more persistent inflation. There are risks that would cause us to, or if they happened, that would cause us to go faster and sooner, and that would be a weakening in the labor market, or for that matter, very, very persuasive lower inflation. Those are the kinds of things. So we're just going to be reacting to the data. That's really the only way we can do this.
Victoria.
Hi, Victoria Guido with Politico. Could you talk a little bit more about productivity growth? You've mentioned multiple times about, the level of wage growth that's consistent with 2% inflation. We've obviously seen, you were talking about ECI this morning, in which it's cooled a little bit, but still sort of above what you wanted to see. Growth has been very strong. How much of those numbers do you attribute to productivity, and do you see that productivity as sort of just temporary because of the factors, the labor and supply chain factors you were talking about, or do you think that productivity growth will fade over time?
So this is a really interesting question, and I think my own view is, I think if you look back to the pandemic, you saw a spike in productivity as workers were laid off and activity didn't decline as fast. And then you saw a deep trough of productivity. And then over the last, you saw high productivity last year in 23. I think we're basically in the throes of getting through the pandemic economy. And the question will be, what is it that has changed? The productivity tends to be based on, fundamental aspects of our economy. Is there a case, will it be the case that we come out of this more productive, more on a sustained basis? And I don't know. What would it take? It would take, people talk about AI, but my guess is that we may shake out and be back where we were, because I'm not sure I see work from home doesn't seem like it's a big productivity increaser. AI, artificial intelligence, generative may be, but probably not in the short run, probably maybe in the longer run. So I'm not seeing why it would, but right now, I would say the productivity is kind of what falls out of the broader forces that are driving people in and out of the labor force, and activity returning and supply chains getting fixed.
Right, so would that be behind why we've seen such strong growth, but we've also seen inflation fall, that maybe there's just a higher level of productivity
That's
right
one
now?
way to look at it, yeah.
Nancy.
Hi, Chair Powell, Nancy Marshall-Genzer with Marketplace. I want to ask a little bit more about housing. I'm wondering, how closely are you watching rent and housing prices as you evaluate whether and when to cut rates? And it seems like housing prices are not coming down as quickly as you expected.
So when we think about, our statutory goals are maximum employment and price stability, and that's what we're targeting. We're not targeting housing price inflation, the cost of housing, or any of those things. Those are very important things for people's lives, but they're not, those are not the things we're targeting. We're also well aware that when we cut rates at the beginning of the pandemic, for example, the housing industry was helped more than any other industry. And when we raise rates, the housing industry can be hurt because it's a very interest-sensitive sector. On top of that, we have longer run problems with the availability of housing. We have a built-up set of cities, and people are moving further and further out. So there hasn't been enough housing built, and these are not things that we have any tools to address. But where it comes into play very specifically in our work is inflation, which is a combination. It's really rental inflation. You're taking owner's equivalent rent and then actual rent paid by tenants, and you're running that through the CPI calculation or the PCE calculation, the one we look at. And what that's telling you is that market rents are increasing at a much lower rate or even being flat, and that will show up in inflation over time. It has to, as long as that remains the case. So.
And just real quick, what is your response to the letter that was sent to you by some members of Congress asking the Fed to lower interest rates to make housing more affordable?
My response is what I started with, which is that our job, the job Congress has given us, is price stability and maximum employment. Price stability is absolutely essential for people's lives, most importantly, not most importantly, mostly for people at the lower end of the income spectrum who are living at the edges, at the margins. And so for someone like that, high inflation, in the necessities of life, right away you're in trouble. Whereas even middle-class people have some scope to absorb higher costs. So we have to it's our job, it's what society has asked us to do, is to get inflation down. And the tools that we use to do it are interest rates. So that's how we think about that.
Courtney.
Courtney Brown from Axios. Can you give us some insight into whether the committee discussed the possibility of slowing balance sheet runoff in the months ahead?
Yes. So I would start by saying that balance sheet runoff so far has gone very well. And as the process has continued, we're getting to that time where questions are beginning to come into greater focus about the pace of runoff and all that. So at this meeting, we did have some discussion of the balance sheet, and we're planning to begin in-depth discussions
He's just
of
reading
balance sheet
every
issues
single
at our
part,
next
huh?
meeting in March. So those questions are all coming into scope now, and we're focusing on them. But we're at the beginning of that process, I would say.
Quick follow-up, is it the case that the Fed would decide to lower rates and make adjustments to the balance sheet runoff in tandem?
Yes, we do. We see those as independent tools, and so they don't. For example, if you're normalizing policy, you might be reducing rates but continuing to run off the balance sheet. In both cases, that's normalization. But from a strict monetary policy standpoint, you could say we're loosening and one with tightening. So that could happen. It's not something we're planning or thinking about, but right now we're thinking about getting to a place where we're going to see the balance sheet runoff to continue. We're watching it carefully, and as I said, we'll be looking into that as a committee starting in March.
Thanks.
Simon Urbanovich with The Economist. Thank you, Chair Powell. You've mentioned 6 good months of inflation data, but that not being enough to build up confidence. Based on your previous response that your base case is you probably wouldn't start easing yet in March, the implication is that 8 good months might not be enough either. Roughly how many months do you think you might need of good inflation data to be confident?
Yeah, I'm not in a position to put a number on it. I'm just going to say, it's not that we don't have any confidence. We have growing confidence, but not to the point where we feel like it's a highly consequential decision to start the process of dialing back on restriction, and we want to get that right. And we feel like the strong economy, strong labor market, inflation coming down, it gives us the ability to do that. We think that's the best way we can serve the public, because ultimately we've made a lot of progress on inflation. We just want to make sure that we do get the job done in a sustainable way. That's how we're thinking about it. In terms of when that'll be, that'll all come out of our communications, and we won't keep that a secret.
Hi, Chair Powell. Evan Reiser with M&I Market News. Can you explain a little bit more on what you're considering when tapering QT? Do you need to see the overnight reverse repo facility all the way down to 0, or is it something that you can start with a couple $100 billion there?
Not a decision that we've made, but I wouldn't think we wouldn't be taking a position that it's got to go to 0. I mean, if it were to stabilize at a different level, but that's not a decision that we've made. That's what we'll be talking about at the March meeting. A whole range of issues will be briefed up in the committee. We'll get into all of the issues that will be arising over the course of the next, let's say, year or so.
Greg.
Thanks, Greg Robb from MarketWatch. Chair Powell, I want to change gears a little bit. In the presidential primary campaign that's been going on for the last 9 months or so, your name has come up often, and many Republican candidates had said that they probably wouldn't want to give you a 3rd term. So I wanted to give you a chance to talk about that. Do you want another term? You've had on the Fed. What's your stance on that?
I don't have a stance on that. It's not something I'm focused on. Focused on doing our jobs. This year is going to be a highly consequential year for the Fed and for monetary policy, and we're, all of us, very buckled down, focused on doing our jobs.
Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you mentioned, core PCE has been running at 1.9% over the past 6 months, and you guys are actually expecting core inflation higher this year at 2.4% compared to that 6-month measure. Given that forecast and that the median is for 3 rate cuts this year, what happens if inflation stays where it's been over the last 6 months for the next 6 months?
So we'll update our inflation forecasts at the next meeting. You referred to the December meeting. That's 3 months old, so it might be lower now given the data we've gotten. So look, as I mentioned, we're going to be reacting to the data. If we get very strong inflation data and it kicks back up, then we'll go slower or later or both. If we got really good inflation data soon, that would matter for both that would tell us that we could go sooner and perhaps go faster. So we're just going to be, but of course we'll weigh that with all the other factors. We're setting policy based on the totality of the data.
But just to follow, if inflation stays where it is currently, that would probably mean that the real interest rate becomes more restrictive. Would that mean you'd have to trim more, perhaps, than you already have factored in?
Well, I think if we came to the view that that inflation that the 6-month inflation numbers, which are very close to 2, were in PCE world, if we came to if we thought that is really where we're going to be, then yes, our policy would be in a different place. It would. But that's the whole point, is we're trying to get comfortable and gain confidence that inflation is on a sustainable path down to 2% or toward 2%.
Daniel.
Hi, Chair Powell. Daniel Avis, Agence France Presse. I just wondered if I could get your comment on the recent consumer confidence data. It seems to suggest that consumers are sort of moving towards a much more optimistic view of the economy. I just wonder, is it fair to say that they're moving towards where the Fed appears to have been in recent months? And do you think that inflation and falling inflation perhaps has played a role in that? And what challenges do you see going forward? Thank you.
Yeah, so it's been interesting that confidence surveys have been weak at a time when unemployment has been low, very low, historically low for a couple of years. But nonetheless, that's been the case, and we've asked ourselves why that is. And one obvious answer, we don't pretend to have perfect wisdom on this, but one obvious answer is that the price level is high. So prices went up much more than 2% per year for a couple of years, and people are going to the store and they're paying much more for the basics of life than they were 2 years ago, 3 years ago, and they're not happy about it. And it's fine that inflation's coming down, but the prices they're paying are still high. So that is what that has to be some part of why people are unhappy, and they're right to be unhappy. This is why we need to keep price stability. It's why we need to do our jobs, is so that people don't have to deal with things like this. In terms of you're right. In recent surveys, you've seen a couple of significant increases in consumer confidence or happiness with the economy. I guess that's a good thing. That can support spending, can support economic activity. There's some evidence of that. But you're right. It is a fact that we have seen a meaningful increase. I think levels of confidence are still maybe not as high as they've been at various times, but they certainly have come up.
Thank you for taking our questions. Brian Menace, CNN Business. Committee members have said they'd like to meet with business leaders and stakeholders in person to learn more about the economy in real time, given that some data is subject to large revisions, the issue of seasonal adjustments being thrown off balance, and many readings of the economy being quarterly. So did any members say they've learned anything not yet reflected in the data, or have you yourself learned anything through anecdotal evidence that hasn't been captured in the data yet?
Well, yes. I'm a big believer that yes. So we do meet with outside groups who come from all different parts of the economy, and I always feel like I spent most of my life in the private sector looking at individual management teams, and then building out from that. And so starting with GDP data and working into what's actually affecting people's lives is challenging. It's very hard. So I really like anecdotal data. In addition, as you know, the 12 reserve banks have really the best network of anyone. That in all their districts, they're talking to, not just the business community, but the educational, medical, nonprofit community. They have arms into all of that. And so when they come back, that's what goes into the beige book. But that they come back, and what each reserve bank president does is, during the Outlook go-around, they'll say, in my district, and they'll talk about 100 conversations. They won't talk, they will give you input based on 100 conversations that they've had with people of all different walks. And I personally find it very helpful in understanding what's going on. And also, I think you hear things before they show up in the data sometimes.
Did any of them notice slowing economy based on what they've heard from their district?
Yes, I mean, if you look back at the last, not this beige book, but the one before, there was a lot of slower activity. I think that what you're hearing now is things are picking up a bit. You're hearing, not in every district, and not every person that we talk to, but you're overall, it feels like you're hearing things picking up at the margin. So that's what comes through.
Let's go to Jeff Cox for the last question.
Thank you, sir. Jeff Cox from CNBC.com. Just kind of looking to put it all together. You talked about basically the economy looking strong with 3.3% annualized growth in the fourth quarter. Does the strength of the economy speak more loudly to you now than any inflation threat might? That you're in a position, in other words, to keep rates elevated as long as the economy stays strong, and you're more tilted towards that. And then also, perhaps, are you worried at all that the economy is maybe a little too strong right now, and that inflation could come back at some point?
I'm not so worried about that. It's again, we've had inflation come down without a slow economy and without important increases in unemployment, and there's no reason why we should want to get in the way of that process if it's going to continue. So I think declining inflation, continued declines in inflation are really the main thing we're looking at. Of course, we want the labor market to remain strong too. We don't have a growth mandate. We've got a maximum employment mandate and a price stability mandate, and those are the two things we look at. Growth only matters to the extent it influences our achievement of those two mandates. Thank you very much.
All right, all right, all right. Yeah, because usually now they're playing some crazy music. So, long story short, I saw people on Twitter, everybody say we should be able to pump now. But then at the same second, the price is just falling down, which is actually quite ironical. That right now, prices had a pretty juicy pump the moment the whole FOMC meeting started. It went down ever so slightly, gave a good $500 pump, and now is down actually like $700 from the high point just now, roughly 1.8%. And as you can see over on the right here, nearly every single coin actually is dumping right now. It's not doing too amazing. Long story short, though, it's all the same. It's not something too crazy. It's not something too difficult to understand. I noticed a lot of you guys had beef in the chat here. I'm not sure what happened with you guys. I see some of you guys decided to go for a little fight there, which is interesting. If you've not done it yet, though, guys, make sure you go ahead and press that like button, and we'll probably be back with another crypto update tomorrow. If you want to see a crypto trading update, head over to Dusty Trades. We're uploading a couple interesting trading videos very soon. And if you've got any project you'd like us to talk about, any cool new thing that's hot, let me know down below in the comment section, and we'll get to it as soon as possible. But that's about it for the stream. See you guys later.